All right, folks, let's get down to it. Welcome, 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 welcome. Right. Welcome to our Tuesday night session, 9:15 British Standard Time. So it's good evening from me. I'm not sure what it is where you are in the world, but for me it is good evening. Right. So, as usual, let's take a quick look at what happened today. Uh, must confess, I wasn't actually in the market today. I took a quick look in the morning. Uh, Nothing looked cooked yet in London. The oven got hot in the evening as we went into New York, but unfortunately, I wasn't free to take advantage of the oven. It's been a very, very busy day for me. A couple of very, very significant moves, which, it's the name of the game. So, as always, let's start with the dollar index real quick. We're going to do Fibonacci in a second, but let's just look at what's happened today real quick. So that's the daily on the dollar. Those levels were marked up coming into the week. We have had a deep dive into that daily order block. So I am going to suspect that downward move is done. I might be wrong, but today was the day to catch. Today was the day to catch. Which is why I'm a bit gutted I didn't get it, but hey, that's gone in there. I would expect to see this happen moving on for the rest of the week. Again, I might be wrong, but I would expect to see a fairly strong reaction coming out. Even not that high, at least I would like to see it. So this is Tuesday, that's Monday, that's Friday, Thursday, Wednesday, Tuesday, Monday. So I think it's going to challenge to reverse almost all, if not more, of last week's weekly range. So I think this bad boy is headed somewhere at the least. Again, I might be wrong, but I'm going to hazard a guess that this week brings us back to at least that level there. So that's my thought process. So that brings us back to at least there. If you drop down to a 4-hour chart, you can see what happened real nice and clear. Okay, let's see. So you can see my candles. So these are daily levels, so just ignore them. So we had a stop hunt here. 4-hour stop hunt there. Let's change the color. So we know it's 4 hours. That's purple for me. It can be whatever color you like. That's just for me. So that was the hunt there, in my opinion. So that's the one. This is the market structure break. That's the two. It lined up perfectly with that daily level I drew out there. Price came out, dipped back in here. It went for the manipulation block. This one there. It's going down. Price pushes back up, comes back down through it. So that's a manipulation block. If you wanted to refine your entry, you drop down to a 1 hour chart. So that's the stop hunt there. Comes back, breaks it here. This comes all the way up to here. Actually no, so it breaks it here. Sorry, and this comes all the way up to here. So in this 1 hour, in this 4-hour manipulation block, we see a 1 hour. Let's see, someone's trying to tell me something. It closed off the low of March 3. Yep, you're right. You're right about that, Kiran. Well spotted. And so there is a 1 hour order block here, which you can see there, Right. Cool. So that just about actually let me not, I don't want anybody to think I'm trying to finesse that. That's the exact other block there. Cool. So it just nicks it there. So you had two ways to get into this trade. The first way was to put your entry 2 pips or 3 pips below this other block, as we teach. 2 or 3 pips below the other block to avoid the spread not letting you get in the trade. That would have been, well, actually, no, we don't trade the, I keep forgetting, we don't trade the dollar index. We're just using it as a directional premise. But anyway, if you looked at this Fibonacci here, that was a perfect 78.6. High premium. Boom. And away we go. If I'd been in, I would have been out pretty much where it closed, or where it's closing, because that is 50% of the order block. It's another old or experienced, another quote unquote trick of the trade I learned along the years. That's 50. If this is a significant range by market maker, that's the fair price in that range. Think of that as, think of this candle as a Fibonacci, like we taught last week. That's 50%. Get out there. Of course, we saw this play out in all the majors, but on the ones on our current watch list, so we see here the pound dollar. This was the last quote unquote significant daily stop hunt, but actually we're not going to do that on the daily. My personal trading style calls for directional bias off the daily. In addition to some, actually, you know what? I don't need to draw this out. I think I've already done this already from this afternoon. There we go. So coming into the day, I had that up there. And then on the 4-hour chart, we see, so that's the daily, first of all. From yesterday, we should have expected a bullish day. There's a strong engulfing from yesterday that suggested to us today was going to be an up day. The first move happened in Asia, so I couldn't catch that. But that's the one, that's the two. See that there? That's the stop on the one. That's the market structure break. Let me show you, make it a bit clearer for you. The market structure break is should be the high that drove price down to take the stop on to this one here. It's close to that one, but this is the real market structure break there. So it nicks it above it there. It comes back into the zone. Boom, you go. You drop down to 1-hour chart. That's what it looks like. You wouldn't have taken this entry here. Well, you might have actually. Let's see. What time of the day was this? This was 6 a.m. in the morning. Yeah, so you could have taken this one here. I wasn't awake for this one. I was waiting for a re-entry. I did get the re-entry, but I didn't put a pending order, and I don't know why I didn't put a pending order, but that's just my fault. Today was a very sleepy day for me. I was up till about 4 a.m. last night, and then I had to be up at 6:30 to do something, a group activity with my church. Anyway, if you want to refine this even further, you can go down to 15-minute chart. You see that there. On 15-minute chart, the re-entry was here, and you got that during New York. 1 second, you take the whole candle, sorry. During New York, that, of course, you see this is a daily level from here, and that was drawn out going into the day. See that there, that line there? This is why you draw them out. That line there predicted the entry level here. So you got two options. You can take your entry at the top of the block, put it down there. That would have been 20 pips. It would have paid you almost 80 pips, almost 4 to 1. Or You put it at the top of the engulfing, the 1 hour engulfing, which is the safer way to do it. So that's where it engulfed there. You put that beneath there. So that's 21 pips. If you want to take the whole block, that's 24 pips. In which case, this would only have been a 3-1. Either way would be fine. We see the same thing happen in EU. So, 1 second, blow this up. Let me get those indicators off my chart so you can see this more clearly. Right, the ADR. Why is the ADR? Okay, there it is. ADR, delete, close. So, there's the low, there's the 1, the stop hunt. That's the 2. Market structure break, price returns, boom. How do you frame the trade on a daily? Well, you got a couple of options. First of all, coming into today, you would have been watching this level here. That's the one. Well, that's a huge order block. I am not taking this. This doesn't make sense for the way I trade. Now, if you're a swing trader, 40 pips is a perfect, even a 4-hour trader, as your entry chart, 40 pips is a great stop loss. If you're trading off a 1 hour, 15-minute entry, if you're an intraday trader, intra-week trader, I ain't taking a 40 pip stop loss. I'm sorry, I'm just not. Especially so close to the order block we saw on the dollar index that should end the move. So that's why I'm not taking this. I didn't take this one, and I wasn't even awake to have taken it anyway. But of course, it gives you a re-entry in New York. That's the re-entry right there. So let's get rid of that. You put that there. Welcome, Natalia. Welcome, Ivy. Good evening, everybody. It's 23 pips. That's more like it. So my maximum stop loss is 25. The way I trade, everybody's got to figure out your own trade plan. I'm looking for maximum 25 pips stop loss, and I'm looking for 4-1. So that's why I'm looking for maximum 25 pip stop loss, because for me, a 100 pip trade, by the time price moves 100 pips, I want to be able to get out if I want to. So that's 24 pips, 23 pips. That would have given you almost 4-1. So, of course, the last pair on our watch list was the Swissy. Same thing, same story, different chart. Look, there is the one. Right? Stop loss, stop hunt. On forward chart. Now, this one here is a bit funny. It did not break structure here. Now, you could argue it broke structure here. I don't care. I wanted to break the structure of the low in this case that drove the stop hunt. So until price crosses here, the trade's not even live to be stalked. It did cross in and go back immediately. In this case, now we wouldn't have known this at the time that was forming, but in hindsight, this is the manipulation block that it used to get its bearings. But if you drop down to 1 hour chart coming into the day, you'd see it clearly. So we're in that manipulation block right there. You'd refine it on a 1 hour chart. In that manipulation block, you can see this order block. That order block right there. So the first entry again would have been 6 a.m. That's, well, this is 5 a.m. actually. Actually, no, it would have been 6 because you'd be waiting for the engulfing of the 1 hour candle. So that happened here. In essence, you would have been in the trade here. Put your stop loss either there for 10 pips, or Swissy has been giving some very interestingly precise entries the last couple of months. That would have been a 14 pip stop loss at best, at worst, sorry, maybe even a 10 pip stop loss. And you would have had almost 7-1. Cry me a river. And if you missed that entry, well, like I said, New York more often than not will give you a second chance. That was New York second chance. Slightly bigger stop loss, which is actually the exact same, 10 pips. 10 pips, boom. So, good day. Good day if you took any of the trades. I didn't, sadly, but it is what it is. So, let's finish Fibonacci's. Now, first of all, any questions? The class on Fibonacci's from Sunday night was the longest I've ever taught, especially on YouTube. The longest teaching class I've ever done. And it was because a couple of you kept asking me to break Fibonacci's down meticulously and systematically, so I decided to do so. But I do realize it was quite heavy. And I do also understand that a couple of you guys are going to have to probably watch it once or twice to fully get the gist. So, and maybe a couple of things we need to go over. So before I carry on, is there anything from Sunday night's class? Okay, so I'll ask a question. When I say wait for a candle to finish forming before placing the trade, I wish, let's see if I can find a live candle, because the Asian session is just about to start. So it's likely to be a bit dead in the market. Let's look at the JAPI pair. So let's look at an Asian pair. AUD JAPI, great. Okay, somebody, Kiran wants clarification on engulfing candle. Good, I'll show you that. So this is, Tucker's definition differs from yours. Not really. Slight variation in terms of preference. Like I said to you, Kiran, the more experience you get with the institutional order flow, you find your signature and you find what works for you. And many times finding what works for you means bending certain rules. Let me be honest and say that. Many times it means bending certain rules to give you more entries but more losses. Okay, let me say that one more time. As you get more experienced, you start to develop your signature. And what I mean by signature is you take the objective rule and you twist it a little bit in one direction or the other. Because you twisted the rule, you will lose trades because you haven't waited or you violated a portion of the rule. However, your trade-off is you will also get more entries. And so the experience is figuring out which tweaks make the extra profit worth the extra few losses you will get. Okay, Gerard, this is a yeah, I know exactly who you're asking on behalf of. This is an advanced forum. So even though I know we have beginners here, and I want them here because I want to begin to expand their mind from the beginning. I want them to see the end from the beginning as we go there. But we can't take time to show basic things like how to enter a trade here. So I'll do that tomorrow at the Beginners Close Forum tomorrow evening, 9:15 tomorrow evening. I believe we have a Beginners Close Forum. We will deal with that there. So back to Kieran's question. Over time, you find out which tweaks have the extra profit worth the extra loss. So for instance, one of the tweaks that I sometimes make, and again, this is where trading is as much an art as a science. We teach you the science first, you figure out the art over the rest of your life. And so sometimes there's a gut feeling to it. Once you've got the rules down, there's a gut feeling to it. But there are times where, for instance, I will look at a setup and I will just instinctively know that on this setup here, let me give you an example, that on this setup, go for the wick of the candle, right? It's just a gut feeling. Some other setups, it'll be go for the body of a candle. Again, how do you know? It's a feel. The full rule is take the whole candle, right? That's the full rule. Take the whole candle. But if you look at this candle right here on a daily chart, let's look at this. The wick of this candle, the top wick alone, Okay, that's not that. That's not that. That doesn't. Okay, this is a 1 hour candle. Sorry, let's look at a daily candle. Right. Let's look at daily candle. Right. Let's look at this one. So this candle here, the wick alone is 81 pips. The entire candle is 211 pips. If I instinctively felt, as was the case here, that this was a body situation, if I drew my zone with just the body to set a pending order, I'm saving on an extra 81 pips of drawdown that I don't need to encounter. If I took the whole rule, this would be my zone using this particular candle there. That's a 211 pip stop loss. I set my pending order here, and by the time price reaches the zenith, I would have said that's 211 pips. So I'd have done 2.5 to 1. However, if I tweak that rule a little bit and I say my zone is just the body of the candle, my risk to reward ratio now goes from 2.5 to 1, so that's 92. So that's like 7 to 1 now. Of course, there will be times where price goes through that body and comes here, right? So there will be a few trades that I lose that I could have won if I'd just taken the whole zone. But if I've calculated by experience that 7 times out of 10, if it violates the body, it violates the whole candle, well, if I'm increasing my risk to reward from 2.5 to 1 to 7 to 1, and there are only 3 times out of 10 where that will cost me 1%, you can see how even with a lower win ratio, I have much more profit. And this is one of the things that as traders you have to be comfortable with. It's a game of percentages. You will lose. No setup will be 100%. The only setup that's 100% successful is the setup where you never have a stop loss and your account is big enough to sit through months of drawdown. Very few people have that kind. I'm talking about you have an account size of like 10 million and you're risking, and you're, I don't know, right? Don't do that. Put a stop loss in. Based on experience, calculate a high probability edge, accept the losses, and hope that your profits compound. Right, so that's that. So Gerard, what do I mean when I say wait for it to close? Well, let me give you an example. Let's drop down to a 15-minute chart on this pair. We may see some action right now. Right, so this 15-minute, let me go down to a 5-minute chart. Let me go down to a 1-minute chart. Aha. Can you see that? That candle is still forming. This last candle here is still forming. Now, this is a 1-minute chart. It could as well be a daily or monthly or whatever. The principle still applies. While it's still forming, right now it looks like a mini doji. Before that candle finishes forming, it could go all okay. Now, so that one's finished. Now look, this one started. So now we know that was how that one ended. This one's starting now. Gerard, I want to ask you a question. Do you think you know exactly how that candle is going to end up? This one forming right now, this last one here. Can you, with any degree of confidence, say exactly how that candle is going to form when it's done? I'm waiting for Gerard's response in the comment section. And because of time, I'm going to guess what your response is. The answer is no. Could you see how it changed quickly? Look at how that candle changed from a flat line to bullish, to significantly bullish at the moment. So at the moment, this candle here has engulfed this one here. It could go back flat again. It could end up going down. Until it finishes forming, you have no idea what kind of candle it's going to be. You may think you do. I've seen hour candles that look bullish, and then 5 minutes before the hour was over, price just wildly goes the other way. And so anybody who was, say, waiting for an engulfing and thought there's my engulfing and was cheating would have gotten burnt, because before the candle is over, what looks like an engulfing candle now ends up not being an engulfing candle, or vice versa. Now, it's all right. So, answer to my first question was not exactly yes. You're right. You don't know how it's going to form. Answer to my second question was you can see good. So, on a 1 minute chart, it's easy to wait. On a 1 hour chart, it's not so easy to wait. See, that's the candle forming this hour right now. That could end up going up or down or flatlining. You don't know. And even 1 minute before the candle forms, you still don't know. So you wait for that candle to finish forming. You know one candle has finished forming when the next candle has started forming. And then literally 1 second after the first candle ends and the second candle starts. So for instance, if when this candle was forming, 5 minutes before the end of the candle, it could still have been up here. In which case, it would not have been an engulfing. At this point, it would not have been an engulfing. I've seen this happen in the last 5 minutes, where in 5 minutes, it just drops, boom. You wait for it to, and also notice here, 1 second. If you were using this candle as a zone of re-entry, right? Or to enter, sorry. If you'd entered when it was all the way down here, you would have had some drawdown before the end of the candle. In essence, there's an extra 4 pips that you could have added to your profit that you've now lost because you were in a rush. It might not be much if you're a swing trader. If you're a scalper, those 4 pips could be everything. So you wait for the candle to finish. In this case, your entry would now be here, or your zone of re-entry. In essence, if you're waiting for this to happen, say for it to break market structure here, and then come back to give you an entry, you could then frame your entry point, if you're using my tweak, as this, as opposed to this. So these are some of the reasons you would wait for candle to finish forming. Any more questions? So any questions specifically about Fibonacci from our last session on Sunday? Any questions specifically about Fibonacci? Yep, Kieran. Finish means wait for the candle to close. And let me add this. One candle closes when the next starts forming. Right, so any more questions, or any questions specifically about Fibonacci? All right, I'm assuming the answer is nope. So let us finish that. Tonight should be a short session then, because there's not much. Well, there is much. There is a bit more to cover, but at this stage, there's not much more I want to add to the Fibonacci teaching right now. Will today's class be as long as our Fibonacci? No way. Not a chance. Not a snowball's chance in hell. Not at all. Not at all. For both selfless and selfish reasons. Right. So Let's see if I can find some of those charts we used last time. Where are they? All right. Let's see if I can find them. 61.8%. So a Fibonacci ratio of the previous class's duration. Yeah. A premium. I like that. I like that joke. Right. So where are you? Where are you? Okay. All right, that's fine. It's all right. We'll just be like that then. We'll just start again. Right, so I'm actually going to delete that, close, and just open up a brand new one. Okay. So we looked at the concept of Fibonacci. I'm not going to go through, I'm not going to repeat what we did last week on Sunday, last Sunday, sorry, because I don't want the class to be that long, right? Cool. So high to low. Yeah, high to low. And we're comfortable now, hopefully, with the concept that we have a fair price area that's between 61.8 and 38.2, equidistant of 50. So that's fair price. Just put that in again real quick. Insert text. So fair price. And then we have the region between 100 and 71.8, 78.6, sorry. We call that a high premium. These are the retracement levels, not the expansion levels. A high premium. And then we have the region between 0 and 21.4. We call that a deep discount. And in between, we have this region between 38.2 21.4. Let me see if let me blow my screen up a little bit so you can see the fib levels a bit more. Right. So let me move these over here. So here is a deep discount. That's 1 second. Deep discount. Here is just discount between the 21.4 and 38.2. It's not deep, it's just a discount. This region here is fair price, anywhere in between 61.8 and 38.2. That up there between 100 and 78.6 is a high premium. And just here, we have a regular old premium. And so Fibonacci divides for us a market maker range. We looked at how to draw the range. The range isn't live till it gets back to the 61.8. If it's an up move, or back to the 38.2 if it's a down move. Cool. So, and then we looked at a couple of ways to use it. You can use it to spot profitable entries. Anything from 38.2 downwards we consider profitable. If it lands in between 38.2 21.4, like I said, that's the quote unquote sweet spot. Or if it's the other way, if you're looking at a down move and an upward retracement, if it lands between 61.8 and 78.6, because you are assuming that all you get is back near the old high or the old low if it's a downward move. And so you want something that gives you at least 3 to 1 within that range there. And perfect would be if you could get it from the 21.4. A trick to teach you or show you, if it crosses more than the halfway point between the 0 and 21.4, or more than the halfway point between the 78.6 and 100, if you get this, for instance, like this here, this one here, don't take this straight down there till it gives you a reaction. If it came down this deep, make it prove to you that it's committed to you. Don't marry the trade after one date. Right? Make it put a ring on it. All right. So, and on the flip side here, you see this here, when it comes this deep, it could be telling you it's ready to leave the zone. So for instance, if this was a retrace, if you were looking at this here, right, as a retracement to go further down, the fact that it came up there is telling you I want to go up, especially if you're dealing in this case with bullish market structure. So when it crosses this boundary up here or this boundary down there, it's usually a sign that it's trying to leave the range. And as we see here, it does leave the range. It comes back to the fair value here to get more momentum, pick up more orders, and then it goes. So now, today, I want to focus on, and we looked at how to use it. Also how you can drop down from a higher level time frame to a lower level time frame. And then now, rather than using the Fibonacci for entries, you use it to give you a rough idea of where price is overall in the bigger picture. So for instance, let's use a 30-minute chart here. For instance, in this region here, when it traces from deep discount to discount area, price continues to move in that direction. Kieran, could you explain what you mean? So when it retraces from deep discount to discount, price, it could go from deep discount to discount and then keep going further down. The same way it could go from high premium to from premium to high premium and the other way. So don't be fooled. Don't base trade ideas on that. In fact, let me put this. This is one of the things that I do teach at the very beginning. I don't know why I haven't said this so far with this batch of students. Price can do whatever it wants, right? Price can do, you gotta be, as a trader, price can do whatever it wants. The only rules it has are rules of institutional order flow. Everything else is a guesstimate. So don't try and bend the market to your will. Just flow with it. If it wants to move from deep discount to discount, so watch for institutional order flows, highs, lows, market structure breaks, order blocks, liquidity profiles, fair value gaps, time of day, time of week, the way candles form, from a bullish candle from open to low to high to close, for a bearish candle from open to high to low to close. Those are the rules it follows. Everything else, just take it as it goes and follow it. So here, like I said to you last week, if we came up with a rule that until price leaves this zone, we're only taking buy trades from discount to deep, we're only taking buy trades in the discount and deep discount, because like market makers, we want to buy at a discount and sell at a premium. It makes sense. You buy a commodity at the lowest possible price you can get it. You sell it at the highest possible price you can get for it. When a market maker swing forms, high to low forms, they're telling you that this is the range of price in this moment. If this is the range of price, this is the higher level of the range, this is a lower level, they're going to want to be buying when it's cheap and selling when it's expensive. So, in essence, we could take an entry here. Of course, we'd use, let me put the daily dividers in. We'd use institutional order flow for that. We'd use order blocks and time of day and open, high, low, close, and all those other things to frame our trades. But we're only looking in one direction on a particular day. So on this day here, we're only looking to sell. This one here, let me blow that up a little bit. Oh, no, then you can't see discount, premium, and whatever. Okay, fine. So on this day here, we're only looking to sell. So when price opens up, if we're only looking to sell, right, we are only interested in an entry above the open of the day. Simple. And there's something I'm itching to show you, but the experienced traders will see it. The not so experienced ones won't. So let me be fair. I'll teach it in a future class because it's a principle I haven't taught you yet that I'm itching to show you. But for now, let's just divide the day at the open. Open, high, low, retracement. Actually, this is the low in this case here. Low. No. This is actually, this day runs all the way down here. That line was let me take the Fibonacci off now that we have that there so it doesn't distract me. Cool. I'm going to take these levels off as well so they don't get in the way of my eyes. Right. So this is your wick at the top of the day. Now, Kieran, for people like you who don't have the time to trade intraday, there's times when I don't. This is one of the tricks that I use. The day opens there, right? If you believe it's going to be a down day because you're guessing it's going to be a down day because you're in an area of high premium based on this range, right? Well, let the day open up. Wait for it to go higher, or basically, by the time you wake up, it's above the open of the day. Just set an entry for when price comes back to the open and put your stop loss at the high of the day. Or if you don't know, if you have time to check it at least once during the day, but when price is up here, right, just put your stop loss down there, or put your entry down there. That's where the day opened. When it gets back, there's a sell stop, and put your stop loss on what you currently believe to be the high of the day. In this case, that would have been 18 pips. The day would have paid you almost over 4 to 1. However, the truth is, you don't know for a fact that's going to be the high. It could have formed a higher high. So those are the days you will lose, or the days where you guess the direction wrong. The other way you can do it is simply at the open of the day, meaning the close of yesterday, right? You put an entry there because you believe we're coming down. And you can do one of two things. You can either put the stop loss at that old high there, or, and I learned this from someone I watched online about 4 or 5 years ago, just 30 pips. Just the day starts, just tell yourself between 30 and 40 maximum, let's say 35. Let's 35 pips, right? Just put a stop loss 35 pips above and tell yourself if it hits that stop loss, it means I guessed the day wrong. That's a loss. Move on. 35 pips from there would still have gotten you 2-1 that day. And if you stayed in, of course, if you're an end of day trader, you are probably going to stay in a trade a couple of days at least. But even if you got out there, that's 2-1. And then you set another trade here, entry, right? Again, 30 pips. That will have given you an extra 2-1. The moment you get back down into this white level here, you're looking to close your trade. And definitely when you get here. Now this day here, this is the day we visited deep discount. So now, the next day, we're only looking for a buy trade. If we're looking for a buy trade, this is the open price. There. Our order has to be beneath it. Now, if you can trade intraday, you can wait for London or New York to give you this entry. But if you can't, again, just go 30 to 35 pips from here. 30 pips would be basically that's I wouldn't go 30 if the existing low is already less than 30. But let's say 30. That's here. And then that day, you would have gotten not even 1-1, but if you stayed in the trade the next day, it would have gotten you, I don't know, almost 2.5-1. Of course, by the time you see this happen here, you just get out. Just cut your losses and get out. Don't wait for it to come back and stop you out here. This is a powerful sign. It's reached a premium and it's reacted at a premium. You know it's coming back down to the bottom of the range again. The next day, so this reaction has happened this next day. So let's assume you're not sure, so you don't know, right? You are just in the fair price region here, right? So you start the day. Am I going up or down? If you're an end of day trader, don't take a trade here because you're not sure. You're in the fair price range. But if you can look intraday, it opens, goes up, comes down. Once it gets back to deep discount, get out, because even in the same day you can see the reverse happens. The next day, we are now here in premium. So technically you'd be waiting for an entry to go long, right? So you get one here, but then this is where you'd lose your 1%. So this is the first day you would have lost in this range so far. And this is what we call a Z day, a day where price works both sides of the open. This is a classic market makers manipulation day, and they usually happen on Fridays and Mondays. Let's see what this was the 1st of July. Can somebody check for me what day of the week the 1st of July was? Not always. They will happen on other days as well. But these are one of the reasons why I just leave Fridays and definitely Mondays alone where I can, because they're classic days for this to happen. Okay, 1st of July was a Wednesday, so that's fine. That it didn't work out that way, that's fine. But you will, if you are a strict system follower, a high number of your losses will come on Z days. So just write that down. We'll show you what they are. But Z, because it's like a Z, it goes both ways, right? In essence, you can't use the rule of open, high, low, close on these days. This is the 10% exception to the rule where price just works both sides of the range. Cool. And then you have this other day here. Again, we're back in the fair value area. So what do we think price is doing? We don't know. So at the start of the day, we're not sure where price is going until it leaves the fair value area. The moment it leaves the fair value area and gets into premium, it's now ripe for a sell here. This is New York, right? This is New York time. It's run back into that high here, that order block there. It's in an area of overall premium. Of course, you're thinking sell, and now it's above the open of the day. Great. These are the days with long wicks. So you frame your trade using that order block. You wait for the engulfing on an hour's chart. If you did either here or here, let's use the full one. That's 11 pips. If you take it all the way up here, that's 20 pips. That's a 70 pip trade. And of course, you're now guessing this is going to be a down day. So open, high, low, close. The next day we are back again in fair value. So we wait, right, until the market shows its hand. It moves from fair value. Also, if you didn't trust this, let me go back. If you are a risk averse trader and you didn't trust this, put your Fibonacci, right? It breaks market, that trade breaks market structure there. That's a low there. Even if you took it all the way down here, just say it broke market structure there, right? Well, it comes back up. It comes back up. You take a re-entry at 61.8, put your stop loss there, and then you can get in that way. And then the next day again, you're not sure, but then it comes down, comes to discount, meaning buying area. There's a liquidity hunt there. Look at that. One market structure break up here. Pretty much same line. Two, right? Comes back in. It's still in premium. It's still in discount. Sorry, you buy. This one takes it all the way here. At this point, we know this trade's trying to leave the zone, but now it's in premium. So okay, do you get a bearish signal? Well, you do on this particular day. You do get a bearish signal. It opens, goes up there, breaks market structure, comes back a second time. So if you wanted to, I would be a bit funny about this. By this point, I'm not looking south anymore. I now know what this trade's trying to do. It's trying to push up there. But if you wanted to milk that last downward move, you could do it there. And then finally, on this day there, it opens up, comes down to the fair value area, gives you that, runs away, comes back down one more time here, and this time it's a stop hunt. And you will see these a lot. If you draw your Fibonacci from a 4-hour, 1 hour, you will see that when price is trying to break out and expand fully to the upside, it will come back down into the 50, 61 to 38 to the fair value area and do this. This is it asking for one last push of liquidity. It's coming back to the average price one more time, and it leaves the range here. And this day, once on this particular day, this is the first day the price closes above the range. This range is now dead. For now. The king is dead. Long live the king. You need a new range until price comes back in there. You notice that 2 months from now, 1 month from now, if price comes back in there, it will still respect each of those 5 zones we've drawn. But right now, we've left the range. You put up a new Fibonacci. Do you get that so far? You guys get that so far? Especially to the advanced students, the experienced students. You get that so far? Okay. So the last thing I want to do tonight is start off, I'm not going to finish it, just briefly start off talking about the expansions. Now, you've seen me use them already. There's a couple of ways you can use the expansions. So let's draw them out. So we go from high to low. So the same way we looked at the relevant retracements, let's look at the relevant expansions. Again, this is all down to experience. I use the positive 161, well, first of all, 121, 161, and 261. And I flip it on the downside, negative 121, negative 161. Let me add one here. And negative, one second. No, sorry, 1.618. So that's negative 261.8. This is what I call it. That's the actual value, because minus 1.618 means, yeah, you give it an extra 1 and then 61.8 beneath that. So I wish I could expand this to show you, but I'll send you guys this in Telegram for those of you who are registered students. These are the levels that, based on the way I trade, I want in my chart. Again, as you get more experience, you figure out yours yourself. And so, like I say, I've got 0 to 100. Let me move this to a more, let's go from here to there. So I've got 0 to 100. Those are the retracement levels. And then you've got 121, 161, 261. And on the downside, you got the exact same. The exact same up there, it's just down here. So minus 121, minus 161, minus 261. So, two ways you can use this. The first should be obvious to you from this already. These are target objectives. If you believe you are in the right trend direction, right? When you see this, where, if you are going to hold on to this trade for a long time, where should your exit be? 3 levels you should be looking at. The 121 for a quick exit, the 161.8 for a full exit, and the 261.8 for a, excuse me, 1 second. So it's got some in my throat. So yeah, the 121 for a quick exit, the 161 for a full exit, and the 261 for a long-term exit. Again, this is one of those things where trading is an art, and like Fibonacci's appear in nature as extremely consistent, what's the word now? Extremely consistent coincidences. It's just uncanny how this let's look at this. So let's start here. If you drew coming down, that's the first leg, right? There. Let's go back and find it. So high there to low here. This here to here. Right? 1 second. Is that the right one? Let me see. So that's the high. That's the first low. Did it get back? That's the high. That's the first low. Did it get back to 60? In this case, to 38.2. Come on. 1 minute trader. Okay, anyway, it did. Okay, so it actually got back to, so cool, that's fine. So this is the low then. I'm trying to get it to touch here, but it's not touching, but that's fine. But you see, it comes back to 38.2, so that's fine. So that's the high, that's the low. It retraces to 38.2. Look at your first target here. 121. So that's the quick target. If you want to just get out quickly, well, see, this starts to turn back at this level here. If you were a bit more patient to go to the 161, 1.8, look at what happens when it gets there. The first time it blows through it and comes all the way down, you'll see this on really, really powerful moves where it just goes straight for the 261.8. But look at that. Look at that confluence there. But also look at here. If you got retraced here, it's hanging around that level as well. And then when it breaks. So if you are framing a long-term, meaning I'm not trying to get in and out in one day, except it goes real far in one day. This is an entire week here. If you drop down to 1 hour chart, you can see that over the course of 1, 2, 3, 4 days, and even the 5th day, it gets from here, 121, first bus stop, 161, second bus stop here. See this here? There's a sharp reaction back there. We see this on a 1 hour chart. We didn't see it in a 4 hour chart. And then final bus stop here. Then, and I can show it to you time after time after time after time. Let's go to the down, to the up move. If we take this as, let's see, high to the low. Yep, it does come back and touch that. That's fine. So again, let's borrow these. That's the 161 level, 121 level, sorry. You can see that there's a reaction there. That would have been a good place to take some profits or close the trade down if you're a scalper or an intraday trader. And then here we see the 1618 level. Here we see, and in this case, this is where the move dies completely. If you drop down to 1 hour chart, you see really clear, right? On this day here, this is the high of the day. And it takes out the open of the day. So you could have been worried here that this was starting to go south, and you would have had reason to be worried. But if you'd gotten out here, you could have waited for price to correct itself and get back in when it goes back up. 161 level, see that there? In this case, price just blows through it, but then it comes back in sharply and then goes again, and then that dies there. And I can show you chart after chart after chart after chart. So that's the first way you use it for expansion levels in trend. The second way you use it is a little bit more intriguing, or you can use the expansion levels, is a bit more intriguing. Let me show you this. Let me see. Okay. Now, when you have done, now this is after the fact, right? When you have done your 1 stop hunt, 2 market structure, and 3 entry, how do you again predict a target objective? This is the way I've just shown you, right? You do this. If that gets to the 61.8, that's a live trade, right? So first objective 121, second objective 161. In this case, it never gets to the 261. It's another interesting way to do it is take the last leg that brought price down. So that market structure break level, right? Down to the low. that last leg there, and then use that. It's a very interesting piece of trickery that I discovered over the years, in that if this is a valid swing, that's going to cause a reversal. The reversal will reach usually for the expansion levels. Let me show you another one, just so you understand what I'm saying. Here, stop hunt 1, market structure break 2, right? Okay. Draw your fib from the high that formed the market structure break down to the low there. If you're looking for a reversal, look at how perfect that one is. I mean, I couldn't have found a better one if I picked it out in beforehand, and I didn't. First reaction 121, second 161, third 261.8. So this is just extra confirmation when you are planning your trade. So if you said, for instance, this is here, and then you'd said, I am looking to see this happen, price to get to that order block. Well, this is an extra piece of confirmation. Of course, there is another order block here. And so this is how you frame your trade ideas. There's one there. That one lines up perfectly with the 121. There's another one here. It lines up perfectly. Well, not perfectly, actually. It doesn't line up with, and so that's fine, but it's halfway in between them. And there's a third one here. So if you justified getting out here or getting out here based on the institutional order flow, the liquidity profiles, the order blocks, well, these Fibonacci levels are giving you extra confluence that is a good idea. So if you see a reaction here, get out. Here, not so much. Although this happens here, but then it bounces back up. Here, so these, of course, the first way I showed you to use it would also work. Just draw it from the high. Now this one is the high that forms after the market structure break, all the way down to the low. You see that now in this case here, this is the low here. In this case now it's the 161 here gets respected here. It takes out that high there, but support becoming resistance. Look at that low there, the fair value gap. So it lines up with it a little bit. So you would look to get out here. Again, it's what you like. It's your signature. It's experience over time. But this is how a Fibonacci as an indicator can add more confirmation to your trade. In essence, you're using it the same way you would use a MACD or an RSI or stochastic. When the MACD gives you a signal, or the stochastic crosses over, the RSI crosses over, well, that would be the same as a fib level being hit for when to get in or get out. I am going to leave it there today so we don't have a repeat of Sunday. I think we've done already an hour and 15 minutes. Any questions? And after answering a few questions, we will shut it down here for tonight. Any questions, anybody? Again, I know there's a bit of a delay between when I speak and when you hear me. So, any more questions? Or any questions? Sorry, any questions? If there are no questions, we will call it a night. And while I'm waiting to see if there's a question, a late question, show you our schedule. We're back tomorrow at 9:15. This will be off YouTube, so this is only going to be for registered students. It's going to be via Zoom. Going to have a closed forum tomorrow evening at 9:15. and another one on Thursday morning, and then Thursday evening. One of the 2 Thursdays we may stick on YouTube till we get to the end of this month. We may stick one of them on YouTube, but tomorrow evening will definitely be off YouTube, and then we're back on Friday at 11 a.m. I was gonna see if I could show a little bit about what I'm expecting to happen tomorrow, but I'm not falling into that trap again. And if I start that, we'll be here for another 30-40 minutes. I love trading. I love the market. I could go on and on and on. Watch your Instagram, your Telegram, sorry, registered student. I will throw a couple of signals probably tomorrow based on what I see early in the morning tomorrow. If I like what I'm seeing, I'll throw you a couple of signals that I'm watching as we speak, and we'll follow them through. All right, guys. So no questions, I believe, is what the silence is saying. So I will see you tomorrow. Either myself and or Joshua will see you tomorrow on Zoom off YouTube at 9:15 in the evening. Thank you, Kieran. I'm humbled you feel that way. Thank you so much. All right, guys. Take care. See you tomorrow. Bye-bye.